Well, hello, everyone. This is Jelena Ogilvie, partner and wealth advisor here at Principal Wealth Partners. And we realize that this is an emotional time to be an investor here in 2022. Never in our history have we seen double-digit declines in stocks and bonds simultaneously. On top of all the concerns that we're seeing around inflation and aggressive Fed action, there's a lot to be worried about abroad as well. But what has remained relatively, I'll say, silent up until now is this upcoming election. We are recording just a few weeks away from the midterm election. And so to discuss the economic and political consequences of this upcoming election, I could think of no one better than Bob Stein, who is Deputy Chief Economist at First Trust, who also joined us 2 years ago, right before the 2020 election. So first, welcome back, Bob.
Thank you for having me again.
Yeah, and you're in the same room at home, right? You forewarned me about your dog.
That's right. And same drawings in the background, by the way. I mean, my kids are much older than the background pictures suggest, but I'm too lazy to replace them. So,
well, you mentioned that you were traveling again, so I know you've been incredibly busy. So we're thrilled to have you. Before we tackle this conversation, if I can just share a couple of things with the viewers. You are a chartered financial analyst, and you are responsible for leading a team of economists at First Trust that conduct in-depth analysis and research, correct?
Correct.
Okay. And in your prior life before First Trust, you spent time with the Treasury Department, Capitol Hill, and you were also a journalist at Investors Business Daily.
That is correct.
Good. It sounds exhausting. So you are also currently a frequent speaker in the media outlets, I think CNBC and Bloomberg. And then the last thing I'll say is when you did speak 2 years ago, your team was fairly spot on. So I will leave it at that. And we're very excited to hear what your outlook is for this upcoming election.
Thank you very much. So first thing I want to make clear is that I will talk about the economy. I will talk about the financial markets. I will talk about housing. But before I get into that, I'm going to start with politics. Now, if you saw me 2 years ago, you know, when I talk politics, I don't talk about what Bob Stein, would personally like to see happen over the next couple of years. I'm going to talk about what I think will happen instead, whether I like it or not.
Fantastic.
First things first, in terms of tax hikes, if you were concerned about a major tax hike being enacted over the last 18 months, you got off easy. Count your blessings. When President Biden came in, he wanted to raise the top income tax rate back to 39.6%. He wanted to raise the top capital gains and dividends rates up to 39.6% compared to 20% right now. He wanted to get rid of the step-up basis of death. He wanted to raise the corporate rate, now 21%, back up to at least 28%. He didn't get any of that, which isn't to say he didn't get anything. He got a lot, but he didn't get what I just laid out. What did he get? He got more green-related spending over the next several years. He got a beefed up enforcement from the IRS. And if you're a small business owner, or otherwise, you may be caught in that web over the next several years. He also got some major tax hikes on corporate America, but tax hikes that I like to describe as not voluntary, but optional. Optional in this sense. We have a new 1% tax on stock buybacks, but companies don't have to issue as much debt and don't have to buy back. Companies can issue dividends instead of buying back stock. So it's really, to some extent, an optional tax. In addition, there's a new minimum tax on the book value of major book profits of major companies in the US. But it won't take long for companies to figure out how to rejigger their activities to distribute the activity that might trigger the minimum tax, like overinvestment, to the companies that are going to pay the most taxes anyhow, because they have large profits anyhow. I don't think these taxes raise nearly as much revenue as the bean counters in Washington, D.C. think they will. In terms of other things percolating in Washington, D.C., the progressive wing, the Democratic Party, still wants to see a $15 minimum wage, and they want to see it now. Well, they ain't going to see 15, and they're certainly not going to see it now. What I anticipate happening, probably not in the next year or two, but possibly in 2024, but probably beyond, is some sort of hike to $11 or $12 an hour, phased in gradually over at least a few years, not 15 and not all in one fell swoop. In terms of trade conflicts, we saw a great deal of trade conflicts between the Trump administration and various foreign governments around the world. Joe Biden came in with a totally different attitude. He's much more of a free trader. However, there's going to be one exception, and that's China. We saw that recently with tougher enforcement against technology transfers to China. That's going to continue. No president from either party can afford to look weak on China for the next generation. So we're not anytime soon going back to what I call that 24-year period of trade policy accommodation we had on a bipartisan basis between President Clinton, President Bush, and President Obama. In terms of technology, my theme for the Biden administration is still intact. Lots of barking, very little biting. So why so little biting given all the barking? It's because if you look at the political donations coming from big tech, be it Apple or Amazon or Microsoft or Google or Facebook, they're overwhelmingly in the direction of the Democratic Party. Democratic Party is not led by fools or idiots. They are not in any substantial way going to bite the hand that feeds them. Now, I didn't say zero biting, I said little biting. So where are those little nibbles going to occur? In my opinion, antitrust policy. The Biden administration has the toughest antitrust enforcers for any political or any presidential administration dating back to the 1970s. Big tech is going to be caught in that net. That net is not solely or specifically designed for big tech, but they will be caught in that larger net. In terms of environmental policy, I think you should observe things in two different buckets over the next few years. Bucket number one, changes the Biden administration has and will continue to make that the Republicans have zero power to stop unless and until they take back the White House, eventually, some point in the future. An example of this is raising the automobile mileage fleet standards for US cars and trucks. It's happening. The Republicans have zero power to stop it. Bucket number two, changes the Biden administration has made and will continue to make life tougher for the fossil fuel industries. But unlike in bucket one, I think many of these rules and regulations will be overturned by the courts over the next few years. We saw that already back in June when the Supreme Court said that the EPA had overstepped its bounds, extended beyond its legal or statutory authority. When a year prior in 2021, the Biden administration had issued new rules making it tougher for utilities to burn fossil fuels to generate electricity. They overstepped their statutory authority. We're going to hear that phrase over and over again over the next several years. Back in January, the Supreme Court decided that the COVID-related OSHA rules for private employers, where they were going to have to frequently test or make sure all their employees were vaccinated, even if they're working from home, extended beyond the EPA's statutory mandate given to it by Congress. Back in April, we saw another example of this when a federal district court down in Florida ruled that the mask mandate on public transportation exceeded the CDC's statutory mandate. Prediction: the Securities and Exchange Commission, sometime over the next year or so, is going to finalize rules to make all publicly traded companies in the United States keep careful track of their carbon emissions. Those rules will go into force, in my opinion. And then later on, a year or two later, the Supreme Court's going to rule that exceeds the SEC, the Securities and Exchange Commission's statutory guidance. So over and over again, we're going to hear this theme over the next several years. In terms of the midterm election, I have very different views on the House and the Senate. I think the Republicans have about a 90% chance of taking the House. Now, the House elections are 25 days from today. Today is October 14th. Here are my reasons why. First, because the Democrats are already on thin ice. The Republicans only have to gain about 5 or 6 seats compared to how they performed back in 2020 to take back the House. Midterm elections historically have gone in the direction of the party not occupying the White House, like the Republicans in 2010 and 2014, like the Democrats in 2018. And this time might be different, but probably not. Then I look at Joe Biden's approval rating. I think he needs to be around a 48% to really be a tailwind for his party in the midterm election cycle. He's at 42 or 43 instead. Now, he's higher than he was. He bottomed out at 38% earlier this year. So he's doing better than he was, but he's not at 48%. So I think he's a little bit of a headwind for his party in this election cycle. The one thing the Democrats really have going for them is the Dobbs decision from the Supreme Court earlier this year overturning Roe versus Wade. Because of that, I think there is more intensity among Democratic voters than you would normally see in a midterm election cycle where they have their president in the Oval Office. So I don't think the Republicans pick up 30 seats, which is possible, but unlikely. It's what I thought before the Dobbs decision. But as of today, I think the Republicans will probably pick up 20 seats and get to a majority in the US House. In the US Senate, I also think the Republicans are favored, but I only give them a 55% chance, not 90%. So why the difference between the House and the Senate? Here's the deal. There are 435 members of the House. Every single one of those seats is up for grabs this November, just like it is every 2 years. For the US Senate, there are only 100 members, but they get 6-year terms. So there are only 34 Senate races. And among those 34, Republicans already occupy 20 of those seats. You can't gain a seat if you already have a seat. Democrats only occupy 14 of the Senate seats that are up for grabs. Because of that, the Republicans simply have fewer targets to shoot at to try to get a majority. In addition, when I look at the slate of candidates the Republicans have put forward out of the primary process, they're generally weak in many of the key states around the country. Not all of them, but many of them. So, for example, I'm looking at a state like New Hampshire, where Chris Sununu is the sitting governor, popular Republican governor of the state of New Hampshire. He had an opportunity in this particular cycle to run against the less popular of the two Democratic senators from the state of New Hampshire. There's Jeanne Shaheen, very popular. Maggie Hassan, not so much. You'd think this is a golden opportunity to get to the US Senate, but he took a pass. He said it was personal reasons, and I believe him. But I also think it was because President Trump would probably endorse his opponent in the primary race, and he might lose, and that would embarrass Chris Sununu and limit his political future. So I think in the end, the Republican is very likely to lose from the state of New Hampshire. The Republican nominee, instead, they could have nominated Chris Sununu, and he probably would have won. And then you have a state like Pennsylvania, where I think Dr. Oz might, in my opinion, be a slight favorite at this point. However, the guy's lived in New Jersey for the past 20 years. He is not as good of a candidate as David McCormick would have been. David McCormick was his opponent in the Republican primary. And then you have a state like Georgia, where Herschel Walker is a statewide icon for what he did on the football field 40 years ago. And then you listen to him talk when he's unscripted. When he's scripted, he's fine. When I'm scripted, I'm fine, okay? When you listen to him talk when he's unscripted, you're thinking that guy played about 5 too many years in the NFL. And then you have a state like Arizona, where Doug Ducey, the sitting popular Republican governor, decided not to run, similar to Chris Sununu in New Hampshire. He was worried about Donald Trump, in my opinion, endorsing an opponent in the primary race. And if he lost, his political career would be much more limited than it otherwise would be. So instead, you have Blake Masters, and Blake Masters might win. I don't think he will, but he might win. But he's not as good of a candidate as Doug Ducey. So between the math, the candidates the Republicans have nominated, they simply don't have quite as much of a chance of taking the Senate as the US House. Now, I have Republicans at 55% chance. So I think they're more likely than not to take the Senate very narrowly. But I wouldn't be surprised at all if the Democrats ended up keeping the US Senate. In terms of the presidential election, I know we're 2 years away. Okay, but so I'm only going to paint with a very broad brush. Okay, if Joe Biden wants the nomination, he gets the nomination. But I think in the end, he's only about 40% likely to run. Now, normally you would think, if he doesn't run, then we have a sitting vice president. She would run instead. But I think Vice President Harris only has a 10% chance of getting that nomination. Here's the deal with Vice President Harris. You do not have to be a rocket scientist to be president of the United States. We've had multiple people who are not rocket scientists be president. Ronald Reagan, not a rocket scientist. George Bush, the younger, many things, not a rocket scientist. Okay, Donald Trump, not a rocket scientist. Joe Biden, not a rocket scientist. You don't have to be a rocket scientist to be president of the United States. But if you're not a rocket scientist, you do have to be something else. You have to be perceptive. Ronald Reagan was very perceptive. You can tell by his sense of humor. George Bush, the younger, very personable in small and medium group settings. Donald Trump, if you're going to be a sociopath, you got to be perceptive, right? Okay. You ever know a sociopath who's not perceptive? There you go. It's part of the job description. Joe Biden, maybe not perceptive now, but he was as of a few years ago and throughout his 40-plus year political career. You got to be one or the other. Kamala Harris is neither. She's neither a rocket scientist nor very perceptive. That's why Gavin Newsom from her home state, sitting governor, Same section of the state, the San Francisco political environment, same fundraising base, is already talking about running if Joe Biden doesn't. He has no political respect for the vice president, and that's a signal that other people don't either. Other names on the Democratic side, Michelle Obama, I simply don't think she has the fire in the belly. You have to be a weird person to run for president. I don't think she's weird enough. So in the end, I think she doesn't run. Mark Cuban, he will not run against Biden. But if Biden decides not to run, Mark Cuban might throw his hat in the ring. If he doesn't do it in 2024, then he'll do it in either 2028 or 2020 or 2032. That guy covets the presidency. He's not on TV all the time for his health. Eventually, he'll throw his hat in the ring. If it's not 2024, then eventually. Last name, Howard Stern. Here's the deal. His big negative is that he's a germaphobe. What's he going to do when he's shaking hands with voters in diners in New Hampshire and Iowa? Put a glove on him, put a plastic glove on his hand each time? That'd be nuts. Okay, he is nuts, but that's beside the point. Okay, here's why he has a shot. Because when you think to yourselves about a debate between Donald Trump and Howard Stern, many of us would pay a lot of money to see that. Okay, we're not going to let our kids watch it. Okay, but we would love to see it. And so because of that, I think Howard Stern might have a shot. Who knows? A small shot, but a shot. On the Republican side.
Oh, Bob, really quickly, have to ask, since we are in the state, most of our clients are in the state of Connecticut. Can you address Lamont real quick?
Yeah, he's like wallpaper, political wallpaper, nice and bland, but every once in a while, somebody like that slips through. You never know. He's not going to stir passion among any group of voters, but does Joe Biden? No, he was just a reasonable alternative to stop Bernie Sanders, who, by the way, I think he has a very underrated shot this time around. I mean, everybody says he's too old, but he was too old in 2016 and almost beat Hillary Clinton.
Sure.
Bernie was too old in 2020, and the Democrats had to have a coordinated departure of everybody else in the race, who then endorsed Biden just to stop Bernie. So is he too old in 2024? Absolutely, but it hasn't stopped him before. So I'm putting Lamont up there because he is going to win re-election to be governor, right? So anybody who runs and gets reelected governor, they might lie and say they're not thinking about the presidency, but he is. Okay. Sure. Now, yeah, exactly. So okay. He would be a relatively moderate Democrat, bland, not unoffensive, not stirring passion, but that guy is like Joe Biden. So you never know. On the Republican side, I think President Trump is obviously the elephant in the room. Yes, pun intended. 70% chance of running, 70% chance of getting the nomination if he runs. So he's got about a 50% chance of being the nominee. Ron DeSantis, I think, has a 35% chance. Here's the deal. If President Trump decides not to run, this goes to zero. This 35% becomes 65 to 70% overnight. Wow. Why? Because Republicans are satisficers, not optimizers. Republicans aren't looking for a messiah. They're just checking the first name on the list when they go into the polling booth in their primaries. Is this guy or gal good enough? And if they are, they vote for them. Reagan in 80, Bush in 88. How does a man like Bob Dole become the nominee of a major party? He's a front runner. Romney, McCain, Bush the younger, front runner. Republicans are front runners. Okay, that's just the way we are. Okay, so Democrats, we as Democrats like messiahs. Republicans just looking for somebody who fits the suit, like the Brady Bunch from many decades ago. One more thing about the Republicans. The most underrated candidate on the Republican side is Mike Pompeo, former Secretary of State. He's lost 90 pounds in the past year. He's tan, rested, and ready. He graduated first in his class at West Point. He's not just very bright. He's quick mentally and verbally on his feet. And if he does well in debates, sorry to tell you, debates start about a year from now for the primaries. If he does well in debates, he can exploit that to fundraising. Not on the same level as Trump or DeSantis, but he's got a better shot than anybody gives him credit for. In terms of the U.S. economy, I promised I'd get to that, and now we go. So here's the deal. Most of the American public believes we are already in a recession, or we're going into one by the end of this calendar year. Okay, not the next 12 months, the end of this calendar year. They are wrong, in my opinion, on both counts. I am fully aware that we had 2 negative GDP prints for the first 2 quarters of this year, but people also need to be aware that the government goes back every year, and they will do so for the next 4 or 5 years, revising quarter by quarter what happened this year, okay? They get multiple bites at the apple. I believe they're eventually going to revise that to north of, to positive economic growth, not negative. Why? Because the unemployment rate finished last year at 3.9, now it's at 3.5. Because so far this year, we've added 420,000 jobs per month on average, first 9 months of this year, okay? We've had industrial production rising at a 4% annual rate so far this year. This is not a recession by any stretch of the imagination. Now, I'm not a recession denier. I believe we're headed toward a recession. I think it's going to start probably late next year, possibly early next year, possibly early 2024, probably the second half of next year. We're about 9 to 12 months away. Why? Because monetary policy is going to have to get tight enough to bring down inflation, and a monetary policy that's tight enough to go from inflation as high as it is now back down to the 2% target the Fed has set for itself is also tight enough to induce a recession. Okay, so that's why we're going to have a recession, but we're just not there yet. Okay, in inflation terms right now, last year we had 7%. We're going to finish this year at 7.5. I'm penciling in 4.25 for next year. Now, notice what I'm not saying. I'm not saying prices are going down. This is positive inflation. I'm just saying that prices aren't going to go up as quickly as they did last year and this year. Okay. The Fed and the consensus believe we're going to be at 2.5 to 3% inflation. I hope we are, but I don't think we will be. I still think we'll be above that, just not quite as high as we are right now. What does this mean for the Fed? I think we get another 75 basis point rate hike in November. I think they'll settle down to 50 in December and another quarter at the beginning of next year. So we'll be just north of 4.5%. Here's the deal. What's really important is not just the peak, but what the Fed does after. A lot of people think they're going to peak and start cutting right away. I don't think that's going to happen. I don't think the Fed, once they peak out in rates, is going to cut rates again until they see the whites of the recession's eyes. Okay, so in terms of housing, here's the deal. I have 2, count them, not 1, but 2 methods of assessing residential real estate prices around the country. This is not Westport, Connecticut. This is not the state of Connecticut. This is not New England. This is national average basis. Please keep that in mind. Method number 1, I look at the prices of homes relative to construction costs. Why do construction costs matter? Because if you're building a potential replacement for your home, the cost of the drywall, the copper pipe, the lumber, and most of all the labor matters. Okay, the more it costs to build a replacement or substitute for your home, the more your home is worth. So when I look at the price to cost ratio, we were off the charts basically in 2005 at the peak of the housing bubble. We were pretty darn high back in the late 80s, early 90s. We're still lower, much lower than we were at the peak of the bubble. Okay. We're still lower than we were in the late 80s, early 90s. When I look at the price to cost ratio, not outside the normal range, particularly of the past 40 years. And so because of that, for this one slide, this is saying no bubble. But I told you I don't have 1. I have 2 methods of assessing residential real estate, and the other one is signaling danger. Okay, this is the price to rent ratio. Okay, why should rents matter? Look at it from the point of view of some tenant living in an apartment or renting a house. Okay, the higher your rent goes, the more, all else equal, the higher your rent is, the more interested you are in becoming an owner occupant, of buying your own home. On the other hand, if you're a landlord, the higher the rent that's being generated from your property, the more you're going to ask for if someone's interested in buying your property. Okay. So the higher the rent is, generally prices are higher as well. They don't move in lockstep in the short run, but in the long run, they have to, okay? Just like construction costs. Here's the price and rent ratio, the price to rent ratio at the peak of the last bubble. Here's where we are today, essentially nipping at its heels. And if this were the only thing I looked at, the only thing, I would assume we're in for a mass problem like we had 15 years ago with a housing bust, okay? But this time is a little bit different from that housing bust. Here's why. Okay, first of all, what happened in the last housing bust? From peak to bottom, national average home prices dropped 25%. Yes, there were areas where they dropped more, but there were areas that dropped less as well, okay? 25% from peak to bottom. This time, I'm estimating a decline of 5 to 10%, much shallower than the problem last time around. So why? Why is this time a little bit different from last time? Number one, as I showed you a couple of minutes ago, the price to cost ratio is not out of line with where it should be. Okay, well within the normal range of the past 40 years. That's not a problem. It was a big problem last time. Second reason, before the last housing bubble burst, we had massive overbuilding across the United States for a decade. We had too many owner-occupied homes. We had too many rented properties. We just had too many homes across the board. And so as that bubble burst and people fled home ownership, okay, more interested in renting than they had been before during the previous bursting of the housing bubble, you would expect that landlords could take advantage of that opportunity with more people interested in renting and jack up the rents, but they couldn't. Rents decelerated during that housing bust and then went negative for a couple of years. Why? Again, we had too many homes. We built too many homes in the previous decade. We built so many extra homes that even as people fled home ownership and wanted to rent more, landlords couldn't take advantage of them, okay? This time around, you have no massive excess oversupply of homes. And what that means is that as interest rates go up and people become a little more reluctant to become homeowners and want to stay in their properties more, landlords with no oversupply of homes can jack up the rent. And that's what's been happening ever since they lifted the eviction moratorium last year. And that will continue to happen over the next few years, okay? I'm going to sum it up in a nutshell, okay? Easy chart, easy concept to remember. During the early days of COVID, prices went up the most, construction costs second, and rents were essentially flat. You could find properties where they went up. There are a lot of people who are underpaying because they couldn't be evicted. What's going to happen over the next few years is just the opposite. Rents, which have accelerated, are going to continue to go up rapidly. Construction costs second, prices are going to be roughly flat. 3 or 4 years from now, we're going to wake up and prices, Case-Shiller index, whatever, other index, are going to be basically where they are today. Now, that doesn't mean there aren't going to be months, quarters, years where they're going to be movement up or down, okay? I already told you that once you figure out where the peak and the bottom is over the next few years, there's going to be about a 5 to 10% drop from whenever that peak was to whenever the bottom is, okay? It's not going to be flat every day, every month, every quarter, every year, okay? However, I think 3 or 4 years from now, prices are back to par, back to where they were as of the middle of this year. It's going to take a while, but rents are eventually going to catch up, and that's how this situation resolves. And because rents continue to grow, that's going to put a little bit of a floor on their home prices that did not exist in the bubble that burst 15 years ago.
Okay. Yeah.
Any more questions? I'd love to stick around and answer any you have.
No, I appreciate that. I guess one follow-up question that is coming up a lot in terms of housing is massive shift in mortgage rates this year and the fact that they've essentially doubled in a matter of months. How do you think about that in terms of housing in general? Does that play?
Yeah, it's interesting. Like a lot of people are saying, hey, housing prices have to come down because the payment flow that a new homeowner has to pay is so much higher. And to some extent, that's true. That is a fair point. And that's part of the reason I think home prices will have a little bit of a decline over the next couple of years, whenever the peak and bottom occur. Absolutely. And home building has slowed down, not every month, but generally speaking. Home sales have slowed down. Absolutely. But put yourself in the shoes of somebody with a 2 3/4% 30-year fixed mortgage that they got sometime over the last few years during COVID or immediately before. Okay. That person is not selling. Okay. And because of that, you're not going to see a massive amount of homes put on the market, existing homes put on the market to sell.
Right.
And those who do put those homes on the market might not have to suffer massive price declines because they don't have that much competition. I mean, if you're sitting there on a 2 3/4% home and you're just not going to want to move, okay? And that's going to limit supply and liquidity in the market to some extent. So it's not just higher interest rates bad. It's bad for new home purchasers, absolutely. Okay. But for the incumbents, it's an intense incentive to stay to your home, and that's going to limit supply. So it's not a pure unadulterated negative for the housing market that interest rates went up. It's a negative, but not quite as damaging as those simple examples suggest when they just look at the change in the payment. Like if I know if I have 2 3/4% of my mortgage and know that if I move into another property, I'd have to take a new loan because I can't carry my loan with me. Well, that means I'm only going to move if I'm desperate. And because more people want to hold on to the homes they currently have, and they all charge more in essence, the incumbent homeowners with those low mortgage rates, to get me out of my home, you're going to have to pay me a premium, right? Because you're going to have to compensate me for the fact that I'm going to have to take out a new mortgage. So you have to look at both sides of the transaction. And in the end, it's going to slow home purchases, but not quite as much as the raw numbers suggest.
Okay. We know, again, this year has been quite challenging. It sounds like we may or may not be at the bottom here, and possibly a shallow recession is ahead of us. And that's okay. And that's why we focus on financial planning as you mentioned, talking to your advisor about the opportunities that you can create as you go through this environment is important.
Certainly.
Bob, as always, I appreciate it. I wish you all the best in your travels, and you are always welcome to come back and visit us in your room from your home with your dog.
Thank you. I'd love to do it a year from now. Always a pleasure.
Oh, we appreciate it. Thanks so much.